Keith McCullough, and welcome to The Pitch. For those of you that are unfamiliar with what this is 6 analysts, 6 ideas, 60 minutes. They have to keep it tight, and they definitely will get chirped if they have factor exposures that I do not like. So again, we're going to look at this fully loaded. We're going to lead off today with Jay Van Sciver. Jay, rock on, man.
A good intro, because we have a large cap, less leveraged truck OEM that's, I think, a higher quality name within the industrial sector that performs well in quads 3 and 4. So
nice, Jay. See, you just knocked down all the pins. All the other guys are like, am I long quad 3 with large cap industrials, which are a long in quad 3? Nice. I don't think everybody else is going to have that.
We came prepared, but we're also just lucky. For those who don't know, Paccar is a maker of heavy-duty and medium-duty trucks. And parts, importantly. You can see on slide our pie chart slide. They make Kenworth and Peterbilt trucks in the U.S. and DAF in Brazil and Europe. And on sort of the summary slide on the next one there, you can see there's a cyclical element to this, which is that we're in a very strong truck market. Truck rates are up a lot. Backlogs are up, and the stock simply hasn't moved to reflect what is an extremely robust truck demand environment. The fleet is old. It's been old for a while, and a lot of the current offerings of trucks are simply cheaper and more efficient than the existing installed base. So you'll see some turnover there. But the really exciting part in this particular cycle for Paccar is that, first, this is an industry that supplies equipment to, move 3/4 of total freight, right? This is a big, important end market for equipment, and it's controlled by 4 players, Daimler, Paccar, Volvo, and Navistar historically. And 2 of those players are going through ownership changes under new management, right? So Daimler Truck is spinning out of Daimler. They're going to have their own P&L and be responsible for margins. And Navistar is being acquired by Traton, which is owned by VW. So they're no longer fighting for share just to stay alive. They're going to be part of a major global truck OEM that's interested in margins and returns. So historically, those 2 players, Daimler Truck and Navistar, have been the pricing spoilers in the industry. They've compressed margins in what should be an oligopolistic, high-margin business, right? So that's been, I think, an underappreciated structural change to this industry that I think is going to bring up margins hundreds of basis points over the next year or so. And as that happens, Paccar, you get the cycle, you get the upcycle that isn't priced in. You have a lot of good factor and macro exposures, and you can get to something like $9 on a run rate basis out of 2022, which takes Paccar, I think, very easily into the triple digits, easily 50% upside if that plays out. Next slide, in terms of how it does by quad, it's a pretty good quad 3 and 4 performer for a company that makes heavy duty trucks, which you would think would be, deadly in quad 4. But the truth is, it's a well managed, high quality. There's no manufacturing net leverage, cyclical, right? It's an unusual cyclical in that it has a lot of defensive qualities, and it's an essential piece of equipment. So it performs pretty well in those environments. Slide 6, you can see the age of the fleet. That's a big part of our process. We want to supply into fleets that are old and in need of replacement with significant changes in the quality of equipment. So for example, the fuel economy of trucks being made in 2021 is a lot better than the fuel economy of trucks from, say, 2015. So there's a tremendous incentive to turn over this old fleet at the moment. Not shockingly, in this freight environment, we're seeing on utilization on the next slide quite high, basically 100% fleet utilization. Demand is through the roof. It looks like a lot of indicators kind of going from accelerating to less accelerating, but that's still, in any context, a ridiculously high level of utilization in a growing economy. Growing economy is going to drag additional trucks into it. And it's a very robust demand environment with very, as we'll see in the next slide, robust pricing. So if you look, we can track rates in different regions by category. They're all up. Returns on this investment for buying a truck for truckers right now look quite good. They won't look good when they add a lot of supply in like 3 years, but we'll worry about that at the time. Right now, it's good. People will buy trucks. And I think another underappreciated aspect of that utilization is that traffic is bad and traffic is getting worse. And that tends to snarl the fleet of trucks, which reduces asset turns, which means you simply need more trucks, right? Slow speeds means more equipment. So a very good demand environment. And one of the curious things about Paccar, you'd think like, oh, everybody knows truck orders have been pretty good. But on the next slide, what's interesting is what is historically a correlation between backlog to build, basically how quickly the industry is building trucks relative to the demand that's coming in. That correlation really broke down about 5 years ago, and it's basically been opposite day ever since. And Paccar is at a relative low, despite being, from a macro factor, cyclical and structural standpoint, I think an outstanding long at this point. So you get to buy low at an attractive valuation at the right time, which is generally a big part of our process when it goes well. Slide 10, what's so exciting about the market? Basically, these are the 4 players, right? You should, if you have 2 players with 70% market share, typically have a very high return mature industry, right? And that's not what we've seen because Daimler Truck and Navistar International up there, Navistar had their own problems and has been fighting for survival and is underpriced on marginal units, disrupting a bit of the pricing in the market. And realistically, Freightliners never played ball. They just, for years, they've been, part of Daimler, this bigger organization, and they simply haven't gone for price. But now, on the next slide, you'll see by the end of the year, Daimler is going to be a separately traded, still majority owned by Daimler, but it's going to have its own P&L, its own management team, and is going to need to produce financials for the separate unit. And when you're paid to do it, most likely you're going to get higher margins and returns. And then Navistar, as part of Triton, simply doesn't have their survival issue anymore that they used to have. So they're, I think, going to be less disruptive. So the difficult players in this industry are going to be less difficult. Sometimes you get into these long, boring discussions about electric trucks. Electric heavy-duty trucks, I think, are pretty far, way out in terms of taking meaningful share. But there's concern about how much they would consume in terms of parts. We can sort of calculate that. And I think actually, if it ends up being cheaper to produce an electric truck, first, existing truck manufacturers, like the quote, we're on the next slide, sorry. A quote on the right there, which is that companies, I love this management team because they say things like, we actually have factories that exist and can build vehicles, so that's kind of nice, right? That's versus a Nikola and companies like that don't actually have the ability to produce electric truck. This company does. And you can see some of the stats, and they're adapting to get around some of that aftermarket lower revenue opportunity with electrification, which I think is very far off, right? And there are other things like ADAS and charging solutions that could actually be a great opportunity for them to offset some of the lower part spend. So I think it's a non-issue and it's very far out and it's much less relevant than the change in ownership of Navistar and the spinning out of Daimler Truck. Who are these guys? This is a company that has built an entire parts business out of almost nothing. It's not just Paccar parts, right? This is also Allmake. So they're taking parts share from other companies, good margins in that business. In terms of how they manage, it's a long-term game for Paccar. They take share basically every year in all of their markets. On slide 14, that next slide. That's play long-term games with long-term people, or whatever the quote goes. This is a company with a very long-term focus, still growing share in Brazil and South America. And what do we get? What if you add up all this stuff, a strong upcycle and better pricing? You can very easily get to $9 run rate in 2022. And that is a very different world for in terms of returns and how the stock would get valued. And it ends up making, I think, 50% upside, a very reasonable expectation for Paccar, and an otherwise high quality, factor appropriate, macro appropriate name.
I like that.
So that's it.
Macro appropriate, factor appropriate, market cap 30 billion. By the way, for those of you that don't know how to buy cyclicals, if you just like some kind of calling it up on a chart like people on CNBC do, it trades at this time's earnings. It's trading at 22 times the wrong number, right? It says $4 in trailing earnings. Jay's talking about $9 in future earnings. That's a huge difference in why you want to have an analyst who is going to help you generate alpha with an explicit outcome that is different than consensus. All right, thanks, Jay. Andrew, you're up next.
Yep. All right. So today we're going to pitch Formula One. We've been talking a lot about this one lately, so it's probably not a surprise.
Love this idea. It's the wrong market cap, but I still love it. I still love
Well,
it.
it's over 10 billion, so it's not super super small, but it's definitely not the large end of the spectrum.
Do you know what? By the way, do you know what happened today in 1951? I'm testing to see if you were watching me on Twitter.
Yeah, I saw that this morning. Was it the Ferrari? Did they win the first race, or what was it?
They won their first race. So yeah.
Yeah.
Right.
Yep.
This guy's always paying attention. Fire away, man.
All right. So just quick background, because I'm not sure everyone here is familiar with the sport, but it is one of the most popular premium sports globally. It is considered the pinnacle in motorsport. I think the asset's very unique from a public equity perspective, because instead of owning an individual team like Manchester United, which you can go out and buy today, you can actually own an entire league. So you can think of it more like if you could go out and buy the Premier League or the NFL, but obviously in this case, it's a motorsport. The company generates revenue in three primary sources. So there's race promotion, which is about 30%, which is fees paid to F1 from the host. You have broadcast rights, 38% of revenue, which is pretty par for the course for any media asset, and then sponsorship advertising at 15% is the rest. And that's where we see a lot of opportunities. So in terms of the story here, it's still early, we believe, in this turnaround after Liberty Media acquired the asset from private equity in 2016. It has taken, I think, longer than most had anticipated to turn this around. But what we see with media assets, and especially with something like an F1, which has so many individual stakeholders, it does take time. And we think they've made some pretty savvy moves, whether it was from Drive to Survive, getting launched on Netflix, or being more aggressive on the social media front to connect the teams and drivers with their audiences, where previously they were not allowed to or faced penalty. So really, the previous management team's lack of long-term focus, left the F1 with a poorly monetized base, bad race agreements, and just not as many sponsors as you've seen with many other sports brands. And just by way of example, they entered the year with 18 title sponsors out of a potential 22, if you exclude Monaco, because Monaco doesn't get a sponsor. And now they're coming in at 21. So they're already making up kind of here for lost ground. And Liberty has also been working to resolve these issues, broadly speaking. So in 2020, they reached a new Concord agreement, which is the governing doc, which all the teams have to agree to. It sets the economics of the race and the payout structure. This started going into starting in the 2021 through 2025 season. And it really does improve the economics of a race. It helps with the long-term viability of the sport. It just makes it more competitive, and also in doing so, increases the entertainment value, which you need to do if you want to grow your audience and ultimately monetize. So that brings us to kind of our key thesis points and catalysts, which part of this new Concord agreement, they launched several new race formats, which is they have a sprint qualifying race that starts with Silverstone this weekend. They were able to attract Crypto.com as their first cryptocurrency sponsor. That brought in an extra $100 million of total contract value over the next 5 years, about $20 million a year. We do expect that to drive more fan engagement. It also just opens up more ad inventory for them to go out and sell, hence the Crypto.com deal recently. And then I think, just broadly speaking, as they continue to invest and make the sport just more entertaining, we do have major broadcast renewals coming up in 2022 to 2024. In the U.S., I think is the largest incremental opportunity here. Currently, they've favored reach over dollars with their current deal with ESPN. But we've also seen streaming services come into this market in a big way, snatching up sports rights. We think there's an opportunity for F1 there. And they come up against this big renewal cycle over the next several years. And we'll show in some of the data that we're tracking in a minute why we think that they're going to be set up very well heading into those contract renegotiations. The other key point here, I think, again, as I mentioned before, the biggest incremental opportunity is really around the U.S. And so one of the best ways to do that is just continue to grow their presence by getting more circuits on the state side. So they just got Miami. That happens next year. We think that's going to be a really big deal. We do think that was critical for them to actually secure the Crypto.com sponsorship. Again, these are large tentpole type events. They're similar to a festival. They're multi-day events, and they travel all over the world. And so they do garner a lot of mind share. On slide 23, it's just the new Concord agreement. I'm not going to bore you here with going through all the details. You can check it out if you want. But the point here is that it just makes it more competitive by aligning incentives. Previously, it was kind of, if you could spend as much as you want, and all of these teams would win. That were spending the most, and now that the team payment distributions are a little bit more even, that helps with the smaller teams. be able to invest a little bit more and just helps them financially, because this is a very expensive sport. And so you can see the team budget cost caps going down by $5 million a year, starting in 2021 into 2023. They've also done things on the car regulation side, new aerotech to help just improve the race dynamics. And this is all consistent with, the general strategy of, monetizing a brand. So grow your reach, grow the popularity of the sport. That helps drive the flywheel of advertising and sponsorship revenue, which helps ultimately get you better broadcast rights. In terms of what we think the monetization opportunity could possibly be, we put on slide 25 kind of a side-by-side sport comparison of the viewership for some major sport leagues out there. You can see that F1 in 2019 had about 617,000. That compares to NASCAR, that's 3 million. IndyCar at 1.1 million. The Premier League at 462,000. So it's still small by comparison. But the U.S., as you'll see on the next slide, is by far and away the largest market for sports rights. And today, if you look at F1, we believe that they're currently getting less than $30 million for their current rights deal with ESPN. And if you look at something like NASCAR per year, they're generating $821 million of revenue. So we're not saying that F1 is going to be getting NASCAR type fees, but the reality here is that if they continue to grow the awareness in the U.S., it gives them a tremendous amount of leverage going into these next round of contract negotiations. And so if that goes up to, call it 100 million, 150 million, 250 million, while also balancing broader reach of the sport, I think that's a really big catalyst that's right in front of us. Some of the data sets that we're tracking, so this is app download data, but and Google Trends, but you can see that every single time that Drive to Survive gets released, we see a spike in app downloads for their F1 TV SVOD service and just broader interest, helping just drive broader engagement, which does take a while. On the engagement side, we actually updated this more recently, but this is through March. And you can see that the number of Twitter followers and social engagements continue to increase. And then lastly, this is, I think, one of the most important slides, because this shows how U.S. viewership is tracking on a comparable race and circuit basis. And we are tracking up significantly, over 55% year over year. We'll see if this peters out, but we have we do have Silverstone this weekend with the new sprint circuit formats. So it's going to be really important to make sure that this data continues to trend in the right direction again, because we do believe that these renewals are coming up and growing awareness is going to be key. And I will leave it at that.
Yeah, it's interesting. I think a lot of people, for some reason this morning, whether it was in the early look or on the macro show, thought that I was just going to yard sale everything that's small to. This isn't even small cap. This is 10 billion. So just let's put that on the tape. Actually, I thought Dan Skyver should have pitched Ouster. Actually, he should right now. It's down 7%. People think that I'm just going to yard sale things that are in real time. It's not happening. All right. We like Ouster. We like the F-Wonk. We like Paccar. What else we like? Tom Tobin.
Hey, Keith, can you hear me okay?
Yep.
So I've got the wrong factor exposure with market cap of about just under 2 billion with ATIP on the long side. We had initially picked this up as the SPAC FAII, but as we've sort of been doing more work on a bunch of different vectors around what's going on in healthcare broadly, some of the bigger themes, there's more and more to like here, particularly as it relates to pent-up demand and et cetera. So we did a write-up, which you can see, if you want to read that at your leisure, with the background, with the key investors, the thesis on pent-up demand, sort of thinking through what valuation is, which really ties back to where they've set expectations versus where we think things can go. There's a handful of analysts out on this right now, but the numbers are very new, but we think there's upside there, which should drive valuation. These guys are physical therapy, which is, sort of a second tier type, or at least viewed that way by most doctors. But I think is going to, in terms of how healthcare is evolving right now, is going to take a preeminent or an increasingly important piece of the healthcare dollar as it faces and interacts with the consumer in a much more, a much more value-added, literally hands-on way, and it's going to be sort of in front of sort of a lot of back-end spending that's less useful. Our thesis, really, if you skip up to how ATI talks about their own story and versus what we liked about it. I mean, again, the big piece here is they talk about this proprietary EMR, so they collect a lot of data on patients. They've been doing that for a while. They're very good at acquisitions. There's just some big deals coming out of private equity, the M&A side, which are not in their numbers, are in part of our numbers. But the last piece there, like value-based contracting, as we've been doing more work on, again, the reforms, the trends in healthcare, the big movements of money, we're liking this part a lot more, although again, that's going to be incremental. And you can see that on the next slide, this concept of digital health 1.0, meaning anybody who's addicted to fee for service, anybody whose legacy healthcare is going to lose out to any newer entrant who has a solid relationship with the consumer. And that is what's so exciting about that. That's very much a brand new idea in the sort of ecosystem of healthcare, U.S. medical economy stuff. And where ATI sits is that they have this, they're both in person, but they have this digital piece that allows them to go to an employer and say, hey, we'll save your patient, we'll save you money by preventing unnecessary MRIs and CT scans and visits to the ER. And oh, by the way, we'll get more volume and at a higher price. And that's a really, exciting trick, right? Typically you seed price to get volume. In this case, you're getting both things. And what's different this time, and a lot of people who've been in healthcare for a long time say, why is this time any different when I heard this back in the 90s or the 2000s or the 2010s, like this whole concept of value-based purchasing. And it really comes down to who's on each side of the transaction, that there's just enough technology, there's enough buyers and sellers, and there's just enough density for this thing to take hold. And we actually just had another conversation just earlier today on this whole topic with somebody at a very large hospital system, and getting back all kinds of anecdotes that make sense. In terms of ATI, their M&A base plus this value-based contract, you can see that on this next slide, which is lifted from their presentation. Again, this idea that they can save money on the right-hand side for their customer, and on the left-hand side that they can acquire very creatively. Now, where this COVID has come in and where we're thinking about the back half of this year and particularly into next, on this reduced access to care, there's still a very big number, a large number of people who are avoiding the healthcare system at this point. I know you talked about on the call the other day about what you're seeing in your travels around the country. But for healthcare, broadly speaking, nationally, there's just not a lot of return to in-person care. It's coming, but it's not here yet. And what we measure to be about a year and a half worth of volume is sitting on the sidelines. When we measure that in terms of aggregate hours, healthcare aggregate hours, you look at this a couple different ways. One is the cumulative delta between trend. It's just massive, right? And you can basically anticipate, okay, some of this is coming back, or it's going to come back as somebody who's sicker and in more need of care. But again, as it relates to ATI, more people returning to get diagnosed with knee pain, people returning to get surgeries, people that then subsequently end up in some sort of physical therapy, or go play sports and get hurt, and et cetera, et cetera, et cetera. Like this thing, we think this is all happening. Now, in terms of the data sets that we're looking at, we have a claims index, so we're looking at medical claims, and this time series is for just new patients. Again, what we see there is that it's above pre-pandemic levels. On the next one is Google Trends, and this actually relates very tightly to physical therapy, which is a little bit surprising to me that Google Trends would be this good. But if you can see there that we're now just tapping up against the 2019 levels, and again, I think we're not even on. We're partially there on the way to reopen, and so the back half again we're getting there, but it's the sequential, at least Q1 to Q2, looks very strong. We've also have a relationship with this company called WebPT, or we're trying to, and they're an EMR for physical therapy. Again, the data points look like we're back to 19, and I think the pent-up demand is going to be a bigger piece here going forward. This relates to on U.S. physical therapy. We also run a lot of analytics on larger data sets, doing machine learning, and this is just the forecast here for USPH. Again, the growth algo for them is really same store growth plus acquisitions. plus price, which is, modest or negative. And it definitely looks like they're going to have obviously an easy comp, but a good upside for the quarter as we push that number through their model. We're hearing good anecdotes in our field notes and our field checks. Again, the idea that the volume's coming back, that ATI is in a good spot, that this orthopedic volume is going to come back, the surgeries come back, and then taking this all down to, in the first instance, on their own forecasts. So we think these appear pretty conservative in terms of how they've modeled it out in terms of their own guidance, clinic revenue, other revenue total. Where that backs into a revenue per clinic, again using all their own guidance, they're only really getting back to parity with pre-COVID in 2023, not even in 2022. And I just think that's a recipe for sustained and substantial upside. In fact, we measured it here on the next slide. It's for COVID-19, looking like it cost them about 3 million visits. If you bring them back at some contribution margin, like what do you get? It's a lot. It's a very high fixed cost, labor intensive type business. So the incremental margin should be high. And then what do we think about in terms of the price, which we, stick at, if you think about this thing over the course of the next 2, 3, 4, 5 years, again, with this digital health component, I think being a pretty substantial juicer to the multiple over time, we're ending up, around 355 million in EBITDA in 25. We're up, have upside to 22. So in the first pass here, the stock's underwater for the SPAC deal, but really 15 is kind of a layup. So 50% upside. Could I get it with a little bit of extra pent-up demand on 22? Could I get it into the 20s? Yeah, I think that's absolutely the most reasonable scenario, and one reason why it's been consistently at the top of our long list for several months. And again, the more work we do on it, the more we like it. One big risk to the thesis right here has been wage inflation, particularly for healthcare workers, and we're continuing to follow that. We had a good interview with management. We had that's on HedgeyeTV. And I think their commentary around it sounded very sober, very reasonable. I think they're going to wait it out, and they're kind of expecting for some wage normalization in the back half. I'm less certain about that. So that's one particular risk that we've got our eye on.
Yeah, that risk, by the way, is going to hold true for pretty well any name that you follow. So you can obviously hedge that out, being short other names that have that same wage inflation risk. I guess the big one, and Mike Taylor and I talked about this as well yesterday, it's just leverage and liquidity. So you got a lot of hedge funds that get washed out on the way down. People aren't allowed to hold their positions. Larry Robbins pitched this stock, as you know, when it went to 10. And he's nobody's idiot when it comes to investing on the healthcare side. I'm assuming he'd be buying more here. Unless he yard saled it too. But again, this is a pretty block and tackle business. And as you said, your public link on USPH has got its live updates. So it's an interesting one. Certainly at 8 after it has corrected. So thank you for that, Tom. I appreciate that. Up next, we got Howard. I'm guessing, Howard, you're going big cap.
Big cap, 50 billion, secular grower,
$50 billion,
and crosses over into technology and consumer discretionary.
Holy hyena! All right, so for those of you that don't know, that's consumer discretionary is along in quad 3, big cap, quality, organic growth. That's also what. Again, don't get so caught up in the cap. The factor exposures of the company, organic grower like Formula One, for example. These things are all good. So roll with it, Howard. And you used to be short. And you used to be short this thing, which is I love that.
I was just short a few weeks ago. So DoorDash is the name. Came around to the not away from the dark side to the long side, being a long-term restaurant analyst, knowing that the delivery companies are destroying profitability of the restaurant industry. I was probably biased against DoorDash, but once I got dug into it, it's obvious that this is going to be a really big company down the road. And 3 reasons on the side: growing GMV, and that's gross merchandise value. Monetizing Dash Pass, kind of like the Amazon Prime, and then is advertising model on the horizon. So the important component about the growing GMV is really how companies or how investors are looking at companies like DoorDash, meaning that they are no longer just operating in one lane in the restaurant industry. They're crossing over into convenience and into grocery, and thus the TAM just expands significantly for them. And what they saw is that the number of consumers that placed orders for the first time on DoorDash in new categories grew significantly, and that gets to the second point, and that's monetizing DashPass. So DashPass is a subscription-based model. You spend $9, effectively $10, and you can get as many deliveries as you want in that month. So when you just serving restaurants, that's one thing, but when you open it up to convenience and to grocery, all of a sudden you can get a huge uptick in the number of people that are placing orders, thus the growth in the GMV. And I just equate this, and Brian, who I think is going to talk next, knows more about the Amazon Prime than anybody, but it certainly is, if you think about your behavior, my behavior of people who order on Amazon Prime or become Amazon Prime members, that they expanded their categories, it's not too dissimilar to that. And then thirdly is the advertising model on the rise. This is something that we're talking about. The company's not talking about it. I think that if you look at the competitors in the space, they have advertising models. I'll get to that in a second. But this allows them to, and I could actually cross out advertising and put social. And I was joking with Andrew Freedman before the call started that our worlds are going to converge, meaning our worlds, my world of DoorDash and Just Eats and Instacart when it comes public. These are going to be social platforms as they begin to advertise, and they advertise and have relationships with CPG companies and brands, and you have different members that are belonging to DashPass and using the app and using multiple apps as they become bigger apps, multiple apps, or there's a phrase for that I'm blanking on in a second. There's a huge momentum shift here into an advertising business model and maybe other business models down the road. But for us, it's clear that they should be able to generate significant advertising revenues, and probably we'll talk about it by the end of the year. So the next slide is the one I'm partnering with Albertsons. This was kind of the definitive move. They had made some smaller moves into the grocery store category before, but when you've got a company the size of Albertsons with 2,000 stores, they are officially in the grocery business today. So this is really going to drive GMV. And Keith, this is partially why, our short call effectively was rate of change deceleration in, the people ordering delivery for restaurants. Well, yes, growth is going to slow, but it's not going to nearly slow to what I thought it would be. And I thought maybe they'd have down revenues this year, but that is clearly not going to happen. And so you're going to see a slowdown, yes, but that's fine. This is not a call for next quarter. This is more of a tail call, if you will, but it certainly fits the factor exposure. The next slide gets to.
By the way, just to interrupt you on that, to give you some credit, I mean, when you told people to sell or short the stock, it was at 215 and it went to 115. And sometimes you can be right for the wrong reasons, by the way.
That's true.
It definitely had some issues. The stock is not, it's not been a playground of fun for a lot of the bulls.
That's correct. And they did see a huge slowdown in orders in the first quarter, right? So when they reported that was a problem. But that's going to be less of a problem in the third quarter, and even less of a problem as we hit into next year. And then, we're 9 months away from that, but we're going to begin to see a rate of change acceleration in 6 months. So, the slide that's up on the screen now is what I was talking about, the orders per active user. You can see a huge uptick in the first quarter to 3.32, and that's only going to grow over time. And I'm going to guess that my estimates are probably a little low. So I want to talk about two other things. These are private companies. This is Instacart. Instacart has a $39 billion valuation, where we talked about DoorDash had a $50 billion valuation, but Instacart has $1.3 billion in revenues versus DoorDash at $4 billion. I'll get into the valuation in a second. But Instacart has an advertising model, and they are, and they are really focusing. If you look at who they hired as their CEO, they basically rated Facebook for the last 5 hires, and the new CEO for Instacart came from Facebook and was reportedly widely successful there. So you can see this shift to Instacart, one, for the advertising business model, but two, probably a little bit more of a social media when they come public, we talked about that. But again, it's a private company, so we don't know too much about that. But in the second competitor is GoPuff, and GoPuff is a $9 billion valuation, and it has significantly less revenues, but it attracts a significant portion of its revenues from advertising. So this is all about our thesis and why, if you look at the competitors, the direct competitors that DoorDash is competing against as they move out of that single lane of restaurants into grocery, those competitors have this advertising business model. And you can see that a few screenshots from GoPuff on the next slide, and on their, the sponsored ads and sponsored search ads and whatnot. So again, Instacart, next slide, you can see they have, an advertising business model. And this all gets to why I think DoorDash is going to go to it. And then lastly, on the last slide, I just did, a valuation comparison. As I said, 1.8 billion in revenues for Instacart. So, and they've got they're trading at basically 20.8 times sales on their last funding round. That, who knows whether that's right or not. We're not going to argue. There's some really smart people that are invested in this company. And then you've got, GoPuff at 20.9 billion, 20.9 times sales, Instacart at 20.8 times sales. And then you got little old DoorDash trading at only 11 times sales. But a huge opportunity. They own the restaurant business. They've got 50+% market share there. They've got 50+% market share in the convenience space. They're just now moving into grocery. They're going to be successful there. So you can see how, as I started out in the beginning, the avenues that this company is going in, down in grocery and convenience, are going to add significantly to the growth rate. And this, I don't, just on a valuation alone, you could say that this company should trade equal to where those two companies are coming out at, or potentially coming out at, which means when they do come public, you should see people gravitating toward DoorDash.
When a veteran short seller goes from bearish to bullish, and the signal does too, pay attention. Hashtag pay attention. When you're going into quad 3, when you want to be long organic growth, larger cap, again, and when Coatue and Lone Pine own it, who are two of the best longer-term growth investors out there, you buy it, all right? Nice job, Howard. Really good. And he looks good. Like, look at Howard. He looks awesome. This guy looking younger by the day. How about you, McGough? How are you looking today? Oh, there you are.
I still got my COVID 30. I got to work off. You can see my gym. You can see my new home gym in the background now. It's getting a lot of work. So we're getting there. But I'm here to pitch a company that you and I haven't talked about in a decade, which is the Buckle.
Oh,
BKE. Now
I know it.
You're gonna chirp me on the factor exposure and in that it's 2.4 billion. I'm a firm believer that the pods ultimately trump the quads. Whether they trump style exposure or factor exposure, that remains.
A little bit more than 2 seconds on that. By the way, consumer discretionary is a long in quad 3, and pods. So instead of quads, the quads are born out of the pods. Okay, so the pods are rate of change acceleration in revenue growth, and or pod 2 cash flow growth. So that's what Brian's talking about. I just want to make sure everybody knows about that. And they do, no matter what the macro environment, typically trump the quads. Okay, so this is only for high-level players and people are using the entirety of the pods to quads process. Shoot, Brian.
Yeah, cool, thanks. So what is Buckle? So it's historically a high margin, 20-25% EBIT margin fashion retailer. Got 442 stores, mostly located outside of major cities. The thing you have to remember about this company, it's about as pure a play on the denim cycle that you'll find anywhere. I never talk this denim cycle crap. Like, I'm not a fashion guy. I'm a retail analyst. I look at P&Ls, I look at balance sheets, I tear them apart. But I got to respect the overall trends which are going on. And like it or not, post-COVID, we're entering a new denim cycle. That helps footwear, that helps denim. And this really benefits Buckle to a large extent. One thing that's happening here, and this is really, really important, and it's a key part of the story, it's on slide 2 here, which I think people don't get, is it's a big play on deurbanization. So most of the stores are located outside of major cities. At the same time, you've had your overall demand ebb. You've had stores like Lucky Jeans. These guys are the largest wholesaler of Lucky Jeans, by the way.
Oh, I love those.
And you had Lucky close all their stores, Maurice's, Fossil, Stage stores. These guys all closed down their operations, and they were in the deurbanized areas. So now you've got an economic imbalance. Over the past 3 years, sales per square foot here trended down to $385 a foot because you have a demand acceleration with less supply. You're going to have the revenue per square foot here going to $515 a square foot. So that actually puts a much higher margin back in play. This is a change that's both well ahead of the consensus and I believe is very sustainable. Next chart here, you have a big margin reversion story. Due to a shift in that balance I talked about, you're going to see EBIT margins going back up to 25%. The consensus is in the teens. So our number for this year, and mind you, you got 1 quarter in the bag already. Our number for this year is $5.10, and the street is at $3.56. So we're just massively ahead of the street. We say the street lightly. If you take a look at that chart there, it shows you the buy, sell, and hold ratings and the analyst coverage. Back a decade ago, you had like 12 analysts who covered this company. Now you have 3, and they're from firms that no one on this call has heard of. So they're really little small cap, 4th tier shops. I don't mean to sound obnoxious there. But
don't be mean. There might be another Hedgeye coming along out of those 3. Maybe not.
Maybe.
Might be some rank broker dealer that's trying to generate trading commissions, which is probably more likely, by the way. Go ahead.
Yeah, but then they'd have a buy rating on it, and the analyst is out to lunch. So these analysts are grossly mismodeling. They're low by 45% on EPS this year, and we're likely to see both an upgrade cycle, which is going to mirror the positive earnings revision cycle, and we'll probably have more attention attracted to it because it'll end up being a $4 billion company instead of $2.3 billion company, which will just mean that there's more cap there to trade and more companies are going to want to be involved in. So this is something on this next page here, which is very, very important in the context of the excess earnings and the excess cash flow that this company is generating. It's not averse to a special dividend. So once its cash levels, because it's got no debt, and once its cash levels go over 250 million, you have your chairman of the company who owns 33% of the outstanding stock.
Is that this guy Hirschfield on the holders list I'm looking at?
You got it. He's one of Warren Buffett's bridge partners. This guy gets cash. He loves it. He loves paying himself with stock price appreciation, although he doesn't sell. But he pays himself with special dividends. So based on our above numbers here, our above consensus numbers and cash generation, I think in the back half of this year, sooner than later, you're going to get a special dividend of $5 to $6 in the back half of this year. So importantly, that's likely a recurring event at the margin level that we're likely to see in this new supply demand environment, which you can straight line that sucker. And that implies that right now, this thing is trading at not a free cash flow yield, just a dividend yield in the low teens.
That's batshit crazy, man. That's like, I was looking at the dividend yield of 3% and I thought that was good. You're talking about much more significant.
13%.
Yeah,
and they're going to give it back.
Yep.
Yeah, they're going to give it back.
Yeah.
So when you look at this thing, you're buying forward earnings here at 6 to 7 times X cash, and forward earnings are too low. So if we're wrong, you're looking at about 12X the street estimates of 350 or about $42. That's about 10% downside from current levels. This stock is reasonably shorted. I think about 19% short interest, 19 now. Mm-hmm. So if we're right on this model, and I think I'm right on the model, you're going to see this thing. It doesn't even need multiple expansion, and you get to a $72 stock, and it's currently at $46, and that's going to happen fast. I'm like very notorious for the 2 to 3 year, 3-4 bagger. Those are the calls I love, like your Dufries and your Playboys and your Capris. But this is one where I think your news flow and the numbers coming out of this company are just going to blow people away. So it's really difficult to find a risk reward in retail here. where you get only 10% downside, 40 upside over the course of a 12-month time period, when people realize that this $6 special dividend on 6+ in earnings power is going to, happen every year. It's going to be a Christmas present every year. And finally, if you look at our numbers here, where we're different, it's largely on the margins. So it is really a very big pod 2 story. This is an organic grower because of the denim cycle. And these cycles, mind you, don't last 2 to 3 quarters, that they last like 3 to 4 years. It lasts a very, very long time, much longer than most people think. People clearing out their COVID wardrobes because, like me, they put on a couple of pounds and they got to buy new denim and sneakers and clothes in order to get back into the office again. That dividend yield I highlighted there, it's right now on this year's numbers, it's 16.2%, which is huge, and then 13 in the outer years at the current valuation, using a 72 target, which is a 12 multiple on outer year numbers. You still have an 8% dividend yield on this thing. So I really like it. I think your catalyst calendar lines up really nicely over the next 3 to 6 months. And people are going to be looking at that $6 in earnings power with the $6 recurring special. So that's Buckle, and I like it.
You had me at Lucky Jeans, man. I'm like one of these people that just goes qualitatively on feel, what I wear. That's really, yeah, I'm kidding, obviously. But the fact of the matter, you can either pay. Yeah, there you go. I mean, I have jorts. I kind of captain those into America from Canada. But kidding again, it's okay. But you can either pay 70 times earnings for a pair of hot pants, which everybody has a pair of Lulu these days, or you can pay 8 times, 6 times Brian's number with a huge special dividend for jeans, which other people wear too. So that's an interesting one. Obviously, McGough brings the heat and differentiated ideas. And it's not just right. He's not just right on a lot of things. He brings up ideas that other people aren't talking about. Great job, Brian, as always. Thank you. I know the audience thanks you for that. Now, Mr. Steinbommer, you get to, you actually get, these guys kept it so tight that you get an extra minute.
That's good. That's good.
You're looking tight. Where are you at? Are you going to like a wedding or?
No, this is me every day.
This is what happens. Josh Steiner has joined me running the macro team, so now he dresses up, during the day, and that's the way that it goes.
So today we're going to talk about an oldie but a goodie. We're going to talk about Discover Financial, ticker DFS.
Big caps.
Yeah, it is actually a pretty big cap. Once upon a time, this was a mid cap name, but nowadays it's large cap. It's 38 billion in market cap, and I mean, what is there to say? Let's take a look. So, if we start on slide 68, we'll start with sort of the elephant in the room, which is credit. So, a couple charts here. Chart on the left is 30+ day delinquencies. This is really the broadest measure of credit for a lender. You can really see there's sort of been 4 distinct phases just in this chart from 2012. There was the period coming out of the GFC. Then there was the sort of, long, quiet winter, basically from 2013 through 2015. Then there was the sort of, slow but steady, protracted renormalization from 2016 back through right up until COVID. Then there was the immediate sort of COVID aftermath, and now we're sort of entering the next leg, which is the sort of renormalization part 2. So if we sort of think about how the stock has fared during these environments, it's pretty interesting. So, coming out of the GFC, even taking a step back, really the only time when you definitively don't want to own this stock or companies of this ilk is when credit quality is about to tumble a lot worse. So if you're
in quad 4, I'm sure. Do you have that back test? I'm assuming you do. Maybe you don't have a slide for it.
Yeah. So if you look back to really the last 3 big recessions, 2001, GFC, COVID, those were the 3 major downdrafts for Discover. Outside of that, it's really just been a question of, is it going up quickly? Is it going up moderately? Is it going up slowly? And this chart on the left of 68, I think, is interesting because the time frame when credit got down to the sort of 1.6 range, which is pretty similar to where it is today, is actually an environment that was pretty healthy from a return standpoint. The stock over those 2-3 years was up around 60-70%. Then in the renormalization window, which began in 16 and ran through early 20, the stock almost doubled during that time frame. Then, of course, it took it on the chin in the early months of COVID and really bottomed out sort of middle of last year and has since been moving higher. And you can see on the right net charge-offs. If we go to slide 69, you can sort of get into that a little bit more granularly. Here we're just showing the last 4 years on a monthly, full year cohort monthly basis. And you can sort of see just how anomalous the environment we're in today is. But what's interesting about it is as low as things get, things seem to keep getting lower. So in other words, we're still not seeing this sort of renormalization. We will eventually, but it's taking a lot longer than what people thought. And if you go to slide 70, the reason that matters is because you generally get about 2 quarters of visibility into the net charge-off environment based on the delinquency environment. So you can see the delinquencies there in orange on slide 70, trending steadily lower. That gives us pretty good visibility. The company's actually going to report a week from tomorrow, their second quarter. Those numbers likely going to be very strong, significant reserve release in the cards. But even looking beyond that into the third quarter and the fourth quarter, the credit backdrop, the credit environment remains very conducive. So I think the outlook there is extremely good. If we think about why that's the case, we go to slide 71. We look at non-farm employment. The recovery there has been very steep. We're obviously continuing to fill that hole. There's still a large hole from where we were pre-COVID, but the rate at which we're filling that hole is accelerating. And Keith, as you and I have talked about, there are about 3.5 million people who are going to be coming off of unemployment benefits, really starting about 3 weeks ago and running through the next week or two. So we would expect to see those people re-enter the labor force over the course of the June print, the July print, the August print. And then once you get past Labor Day, you'll be in the back to school environment. And there we see another 2.5 to 3 million people who have left the workforce because of childcare. They can't get it. They can't afford it. Just doesn't make sense. Be able to go back into the workforce because the schools are going to reopen full time. So kids will go back into school. That'll enable people to go back into the workforce. So from a labor market standpoint, that's going to be extremely good. The labor numbers are going to be very strong between now and September, October. So that's going to create a very favorable ongoing credit backdrop for this company. And slide 72, what's remarkable is even with that hole that still needs to be refilled, total aggregate private sector salaries and wages is actually already, and has now been for a little while, back above pre-pandemic levels. So obviously the government transfer payment dynamics played a big role there. That sort of handoff of the baton is occurring currently from government transfer back to reemployment. And then slide 73, the bulk of Discover's business is lending. It's obviously a credit sensitive business, but there is a large piece of the company that's transaction driven. And so what we're seeing, of course, with the pickup in vaccination rates is a return to reopening and travel. So here you see TSA throughput numbers relative to vaccine dose administration levels. Obviously, the two are moving strongly together. And on slide 74, we saw some of this the last time the company reported, which was when they put out first quarter numbers. We were already starting to see uptick in some of these reopening sales volume metric trends. The company was at a conference in mid-June. They actually provided an update on a number of these metrics, and they're still seeing acceleration, not just across 2020, which everybody would be expecting to see, but actually across 2019 numbers as well. So if you look at total volume in May, those numbers were up 24% versus 2019. In June, those numbers are tracking up 26%. If you look at total retail spending on the Discover network, those numbers are up 40% in June versus 2019. And if you look at restaurants, those numbers in June are up 35% versus 2019 levels. And then the categories that have been the hardest hit, of course, travel. Those numbers are now, as of June, are back to flat versus 2019 levels, as are airfare metrics and car rentals are getting back into positive territory as well. So basically everything is on the upswing there. We'll get, obviously, the next big update on that a week from tomorrow when the company reports its second quarter numbers. But we would expect, obviously, versus 2020, the numbers are going to be a blowout. But even versus 2019, the numbers are very strong and accelerating. If we go to next slide, slide 75, the company has a lot of excess capital. Right now, they have a somewhat conservative buyback out there, $1 billion. But even with that buyback, they're in a position to retire about 10 million shares. That should take the share count down to the high 200s, somewhere around 297 million shares over the course of the year. If we look at the consensus share count, the expectation is only for a 4 million share reduction this year. So we think there's upside embedded in that. And then, the next three slides, we look at the quads, our AI system, and where the company stands relative to its peers in terms of its return on tangible relative to its tangible multiple. So on slide 76, this is a look at domestic commercial banks, as well as a number of the credit card companies. We can see the sort of polynomial relationship there between NTM, return on tangible equity, and price to tangible. And Discover right now is trading at about 3.5 times tangible. Fair value on this metric or on this model is closer to 5 times. So that's good for upside of around 35%. If we look on the next slide at how Discover has fared historically in different quad regimes, Quad 2 has been the best performing environment. That's why it's been so good these past 12 months. If we start thinking in the future, although we are still in Quad 2, but if we start thinking about the future, transitioning into this sort of stagflationary environment where growth is beginning to slow, inflationary pressures are remaining high, what does the stock look like in a Quad 3 environment? In that environment, it's been a decent performer, certainly not the optimal regime for Discover. But the thing to realize is that basically all financial stocks stink in Quad 3. So if you're looking across the universe of financial stocks that do reasonably well in Quad 3, Discover is one of them. And then if we go to the next slide, slide 78 here. So this is our proprietary AI system. And one thing that's notable about it right now is that it thinks basically that Discover is the cat's meow. Like it likes Discover better than it's liked it at any point since shortly after COVID hit. So it's basically saying that there is a 53% probability of outperformance over the next 12 months. Historically, when it's been in that 0.5 bin, you can see that in the top left chart on the slide there. When it's been in that top 0.5 bin, the average historic forward return in the stock has been 52%. So, and if you look at the bottom left there, you can see that yellow line, and I apologize, the dates got clipped off the bottom, but it's basically up near the sort of high end of that historical range going back over a decade. So when it's up near that high end of that historical range, that's when the AI system likes it the best. And again, historically, 52% has been the forward 1-year return at levels consistent with where the AI system is screening it today. So for a variety of reasons, we have liked Discover here for a while. The stock's had a nice move, but we continue to like it prospectively as well.
Nice job, man. Professional. And what we're trying to do is help you be a pro. Like, I mean, at the highest level, not a pretend pro, not somebody on Twitter that gets everything right all the time or allegedly so. What we're trying to do is get you away from Captain Stock Picker, getting some pick from some guy at a golf club or on CNBC, and having picks within the construction of a portfolio. Again, as we have quad shifts, you have factor exposure changes, size, what we spent a lot of time on. Steiner just hit on one there. And again, it's about what makes you safe. Like 41% of the stock, top 10 holders own that. And it includes companies like Fido or BlackRock, or if you look at the shareholders capital group, obviously on something like Discover. So again, there's safety in that construction, that concentration. And to Steiner's point, it's versus the alternatives you might have on the financials on the short side. in quad 3. So there's a lot to think about. We never said this game was easy. Nobody, whoever plays it for real knows, or I guess nobody ever said that it was if they played it for some period of time and was profitably doing so. So again, stay with it. Thanks for joining the pitch.